Well, hello everybody, and welcome to this investment webinar brought to you by SMS Trustee News and Global X, all about ETFs. And it is actually entitled Building Smart ETF Strategies for SMSF Portfolios. Very important subject, very popular ETFs among the SMSF trustee space. So great to see some practical application for how to use ETFs to build a better SMSF portfolio. Just a little bit of housekeeping to start with. There will be a Q&A session right at the end of this presentation. For the people online who are attending, right at the bottom of your screen, I'm not sure exactly where, but there should be a little Q&A icon, I suppose you call it. Above it, there's a little text box and a question mark in it. If you could hit that Q&A box and submit your questions anytime during the presentation, that would be fine. Mark will be taking those questions at the end though, so that he can go throughout his presentation without interruption, and then he'll address your queries at the end. So without any further delay, I will introduce Marc. The session is going to be presented by Marc Jocum. He is a senior product and investment strategist at Global X. Just a little bit about Marc's background. He joined Global X in 2023 and is a key contributor to the product strategy and research teams, with responsibilities including investment research and ETF analysis to facilitate market insights, product development, investment strategy, and portfolio construction. Marc has a decade of industry experience, having previously worked at StockSpot, Morgan Stanley, AMP, and KPMG. He holds a Bachelor of Business from the University of Technology, Sydney, a Diploma of Financial Planning, and has completed CFA Level 1. Sensational credentials, and I'm going to hand it over to Marc right now.
Thanks, Darren, for that very warm introduction. Definitely made me blush a little bit, and really appreciate the kind introduction. And thank you to everyone who's joined on the call today, whether you're at home, at work, or wherever you might be, to listen to a topic that I'm very passionate about, being ETFs. So I'm really excited to share with everyone a little bit about how SMSF trustees can build smarter portfolios using ETFs. I'm extremely bullish on the ETF market overall, and I see that SMSFs being a key conduit for seeing that continual growth. So yeah, really appreciate all your time. And as Darren said, please feel free. I want this to be as interactive as possible. So if there is the ability for you to ask questions, jump on the Q&A, ask questions. We'll tackle through everything at the end. This is as much as a presentation I'm meant to give, but also to give you as much insights as possible into how you can construct better portfolios using ETFs. So the more questions, the merrier, which is great. So hopefully everyone can see my screen, and it wouldn't be a presentation without the mandatory disclaimer, just to say that anything I say is general in nature. I haven't taken into account any of your personal circumstances. I'm not going to be talking too much about any of our funds per se. I don't want this to be a bit of a product push, but if you are interested in any of our funds, please jump to our website where you can see all the relevant disclosures, the target market determinations, and any relevant collateral that you may need. Darren gave a very warm introduction about Global X, but for those who don't know who Global X is, so Global X is a leading ETF issuer here in Australia, but more broadly, and if you talk about our global footprint, we're backed by a large Korean asset manager in Mirae Asset, and they are a powerhouse when it comes to global investment management capabilities, north of 600 billion in assets under management. And within the ETF business, because we've got ETF offices all over the world in US, Canada, Japan, South America, Latin America, we've got over 400 ETFs with just north of about $100 billion in assets under management. Now, Global X and I guess Mirae acquired an older business of ours, which was called ETF Securities, which some of you may be familiar with. And as part of that suite, we've now got 42 ETFs. And again, happy to talk through anyone around the types of strategies that we have, but we really focus a lot, and particularly for SMSF clients, whether they're focusing on getting alternative exposures through things like commodities, income strategies like high yielding strategies. And then we've also got we've got some other ETF categories such as thematic ETFs and also more around that core space as well. So we've got about 42 ETFs. We're just shy of $10 billion in assets under management. And the great thing is that our Korean asset manager owner does love the Australian business. So we're continually looking to evolve and build out the product set. So for today, I'm going to go through three different, agenda items. The first is why I believe ETFs work for SMSFs. Secondly is how you can actually use exchange-traded funds as building blocks for your portfolio. And then the all-important but often overlooked strategy of rebalancing and how employing smart rebalancing policies can really lead you aligning with your investment goals, but it can also lead to better outcomes in terms of investor returns overall. First off, why do I believe that ETFs could work for SMSFs? Now, we were discussing offline just about our university days that when you think about how statistically how things work, you may have heard about something called a normal distribution curve. It's just a fancy way for saying that most of the data points tend to hang around the average, and then you've got extreme outliers around both of the tails. But investing is one of the few areas that I believe that tails are driving everything. And by that, I mean that there's only a small number of stocks that are driving the majority of share market returns. And I think this is one of the very overlooked points in finance is that most companies, and what you're looking at the screen is a distribution of all of the companies that have been in Australia over the last 20 years and what they've returned. And you can see that a lot of companies, if you look at the very far left-hand side, have actually lost investors' money. They're actually deep into the negative and some eventually delist. Whereas only about 7% have actually beaten the broader index of the ASX 200. And I think this is where it's important to know that the average stock performer, which you think would be the actual index, has actually not outperformed the broader index. And I actually believe that everyone talks about, Mark, what are the next best stocks to invest in? What's the next 10 bagger? You'll read the news headlines and you'll see 5 stocks for 2025. I actually believe that stock picking is a loser's game, and most people should believe that investing is a zero-sum game where for every underperformer, you have an outperformer. And once you control for fees, really, most managers are actually getting the average return. So if you can control for fees and just actually want to own the winning stocks, sometimes being an index investor is actually the better outcome. And we're kind of trained to, look for the needle in the haystack. And as Jack Bogle, the founder of Vanguard, said, it's just better to just buy the haystack overall. So this is one of the key concepts that I believe a lot of investors don't fully grasp, the fact that only a small number of stocks drive the majority of the share market returns. And yes, whilst it has been, when you think about the Magnificent Seven in the US, the top 10 are always constantly changing. So it's almost this Darwinistic approach. And if you want to own the winners, it's sometimes best to own the index. Some pretty harsh stats that I was looking at is when you're picking stocks, and again, why am I focusing on that is because a lot of SMSFs are still stock pickers, which is okay, and I'll talk to how you can incorporate that in a portfolio. But the harsh statistics are really that stock picking continues to be a losing game because 40% of stocks have what's called a catastrophic loss, which is a loss that is set down more than 70% and never gets back to zero. And that's alarming because as investors, we've got this loss aversion where we feel losses twice as much as we would feel investment gains. So it's a lot more sensitive to us. I mentioned before that most stocks actually lose money. In fact, over half of the stocks actually lose money for shareholders, and about 2/3 actually underperform the broader index. And I think that's one of the most important bits for people to remember is, you could pick a winning stock like Amazon, but you also have to sit through a harsh drawdown of 80, 90% like it went through the dot-com boom. And to ride out that is quite hard to do. So from a behavioral finance perspective, I think a lot of investors would actually be better off not worrying about their portfolio, not worrying about the individual stocks, and instead choose to own a broader market index overall. Moving on to why I believe ETFs will work for SMSFs. ETFs are still a very infant category. And I know everyone is talking about ETFs is becoming a lot more well known. I mean, when I started in the industry, people were still confusing exchange traded funds or ETFs for EFTs, electronic fund transfers. So it's great that the acronym's there. But the harsh reality is if you look at the total unlisted managed funds market, ETFs have only penetrated around about 5% of that. So ETFs are about a quarter of $250 billion industry, which is fantastic, but still a very, very, very small slice of the broader Australian wealth management ecosystem. And when you have a look at how SMSFs are actually allocating towards certain investment vehicles, which is the chart on the left-hand side of your screen, you're seeing that the ATO groups them under listed trust. It doesn't actually decipher between ETFs, LICs, and a whole bunch of other structures, but part of that group is ETFs, is in the orange bar. And you can see that it is slowly increasing, but it is still relatively small. And that's because a lot of SMSF clients, a lot of SMSF trustees still have the bulk of their money in the grey bars, whether it's direct shares, a lot are still invested in cash and term deposits, which is totally understandable, but lacks that liquidity that an ETF can bring. And ETFs have a range of different applications across multiple asset classes. But one of the reasons that I believe ETFs are very important is because of their low cost nature. And the chart on the right-hand side of your screen is just a rough illustration of how paying a certain amount of fees, whether it's 1% or 2%, can really erode your returns over time. And I like the analogy that fees are like these little termites that are literally nibbling at your returns every single day. So the more that you can actually exterminate those fees, the better you'll be for your portfolio. And like I said, it's criminal in my honest opinion that you have a lot of active fund managers charging over 1% for something that you can get fees for very low cost exposure. And we did some analysis that showed that if investors transitioned some of their funds from the managed fund world into low cost ETFs, Aussie investors could save about $4 billion in fees. So there's a lot of fees getting paid to active managers who underperform and who you can get exposure to a very low cost structure, which is why I believe ETFs and SMSFs are pretty much synonymous when it comes to allocating in a portfolio. An interesting study that AussieX, who's one of the major brokers, did, which they had a look at of all their clients that are using ETFs, what percentage are they allocating to ETFs, and particularly from SMSFs. And what you can see is those who are have an advisor actually with them have actually increased their allocation to ETFs versus the self-directed ones, which has increased over the past year, but still, again, that penetration is still very low. And again, a lot of advisors are building model portfolios that include ETFs. And a lot of you on the call may have a financial advisor who uses ETFs. For those that have one and don't use ETFs, I would ask that advisor, why are they not using ETFs? But I still see that that penetration level is going to increase over the years to come as more SMSF trustees are comfortable with ETFs that pivot away from stock picking and active management into the ETF structure. And the great thing about ETFs, and diverting your attention to the right-hand side of your screen, is the ETF market has grown massively, not just in terms of the dollar value, but the exposure. If you go back to the early 2000s when the first ETF came to Australia, remember the first ETF actually was born in Canada in 1991. The first ETF in Australia was actually an Aussie share ETF, and then Global X actually introduced a gold ETF in 2003. So it was really about Aussie shares and commodities up until about the GFC, where we started to introduce global shares and other things like fixed income. And you can see that orange chart, which shows the ETF market based on what the AUM or the assets under management to global equities is now about half of the market. And I'm seeing that increasingly used by SMSFs who want exposure to global shares, but they don't want to have to do it via their direct stock broking platform, but they have to pay high fees and have to worry about the management and the rebalancing aspect. You can get very low cost exposure to global shares, global thematics, and also bonds and fixed income. I mentioned before that SMSFs like that in their portfolio from a risk return perspective. And now ETFs have democratized that, and you can have access. There's now over 400 ETFs to choose from, many of which across multiple asset classes. So I think from a diversification standpoint, ETFs are a fantastic avenue for that. Now, SMSFs are a fantastic case study for not just ETFs in itself, but also around investor psychology and investor behavior. Because one of my favorite quotes is that an investor's worst enemy is their own self. And a lot of investors, through greed, fear, market timing, actually lead to worse outcomes. And the great thing about SMSF trustees is Computershare did a great study across all their cohorts. So Computershare is a large shareholding registry when it comes to holding the underlying instruments. You may have received a paper by the end of the year around tax statements. Computershare is one of those big providers, And they show that SMSFs actually have the longest holding periods when it comes to ETFs, whereas retail investors or just everyday mums and dads or young millennials and things like that, they actually are holding theirs for a lot less. So SMSFs are great because they are more buy and hold investors, and they tend to hold their instruments rather than trading in and out for a longer period of time. And then in the right-hand side of your screen, you're looking at the percent of investor attrition, which is how quickly, I guess, investors are coming in and out of ETFs. And that orange bar right at the bottom, that 1 to 2%, is very, very small, which indicates a really good thing, that SMSFs are trading ETFs less frequently. Just because ETFs do trade every day on the share market when the market is open between 10 and 4 doesn't mean they should be traded. And you see a lot of, whether it's brokers, retail advisors, or even people holding with a financial advisor, you are seeing a little bit more trading compared to SMSFs. So because they've got long, long-term period holdings in terms of not necessarily from a horizon perspective, but from a behavioral perspective, I think that's really attractive and makes ETFs a perfect vehicle for SMSFs. So that's a little bit of background into where the ETF market has been, why SMSFs from a, behavioral perspective are perfect for what I believe for ETF adoption. But how do we actually go about constructing an ETF portfolio? It's probably one of the questions I get the most, because I mentioned before, there's so many different products out there. Your SMSF investment strategy might have quite a few investments already. And I think that a lot of financial advisors will go through this framework together, but that risk appetite is really, really important. And I think that when you're understanding your risk profile, you really have to balance 3 different types of risk. And that's the Venn diagram on the left-hand side of your screen. Is you've got the risk tolerance, which I think a lot of people are familiar with, which is, the amount of risk that you really want to take. But I think the other 2 buckets are a lot more important, which is the risk required. So that's not just the risk that you want to take, but actually the risk you may need to take to achieve those goals. And yes, there can be a little bit of, distinguishing factors between the 2 that might lead you to stick with the risk tolerance, but that risk required shouldn't be overlooked. And then finally, the risk capacity, which is how much you actually can afford to take given the circumstances that you're in. And if you can find that really nice broad intersection of those 3 risk buckets, that's how you can start building portfolios around that. And then when you're looking at the types of things to put in, there's so many different asset classes you can think about. And when I talk about asset classes, I'm talking about a type of investment that has similar characteristics to one another. You start off with the very defensive bucket, which again, a lot of SMSFs already have exposure to. So basic cash at bank, term deposits, and then slowly increasing into government bonds or corporate bonds. But let's say you do have, a high risk tolerance, you might need to take a little bit more risk. That's where you can look to other asset classes, whether it look at things like shares, property, alternative asset classes, to really try and help you with that potential risk-reward trade-off. Because there's no point just being in cash and TDs the entire time, because then either your returns might get eaten away by inflation or eroded by inflation, but you also want to have a nice little ballast to make sure you're not taking too much risk. And the great thing about ETFs is there is literally an ETF for almost every asset class, which is fantastic. So when you're constructing an ETF portfolio, we tend to advise a lot of our clients and investors around building this core satellite approach, which you may have heard of before. And it's really about the core of your portfolio being those key building blocks, those key, very vanilla, very boring, very basic instruments that can really handle any market conditions that come its way. So that's when I'm talking about things like Aussie shares, global shares, both developed and emerging, and also things like bonds and gold on your 2 very important defensive assets to hold. And that should really constitute the bulk of your portfolio. Whereas where you can play with, and this is where ETFs come in handy to get a bit more esoteric or niche exposure, is you can get exposure to certain countries. Let's say you wanted to be more overweight, because in Australia, we do have a home country bias a lot of the time, where we tend to invest in our backyard, even though the Australian market only makes up 2% of the global market. So let's say you may want to invest in the US market, in India, in other types of areas, or if you want a more broader geographic tilt, such as to Europe. Not just that, but you can invest in broader sectors or thematics, whether it be artificial intelligence, cybersecurity, robotics, even a renewable energy and things like that. So I think it's really important that investors build a diversified portfolio, focusing on the core, but also can build satellites around that, And we're seeing a lot of clients as well, particularly SMSF clients, who are looking to enhance their income because cash flow is incredibly important given the cost of living crisis that a lot of us are living through today. So by having your core building blocks of your key asset classes and then the fringes to be income alternatives, whether you're looking at things like high dividend yielding strategies, corporate bonds that are paying better yields than government bonds, looking at things like the options market through ETFs. Those are all kind of these satellites that can really add a little bit of not just ballast to your portfolio, but also diversification in terms of diversification of income, diversification of exposure. And I think this is the right way to construct your portfolio. And if you want to have a bit of fun with the satellites, because investing can be fun, but that is I see as chili or a little bit of spice to the portfolio. Your very boring, very plain vanilla soup that's just simmering over time should really be the core building block, which is the orange part in your portfolio to help you with that longevity. Now, the question I also get a lot is, Mark, there's so many ETFs to choose from. How do I pick the best ones? And you're right, it's very hard. It's like going to Coles or Woolies and you're trying to pick out which cereal you want to have and they all look great, but you're reading the ingredients, you're not 100% sure which one you want to pick. And I think with ETF investing, just because there are a lot of options doesn't mean that you need to invest in a lot of options. There's been some great research that says that you only really need anywhere from 5 to 7 or 8 ETFs in your portfolio to get broad diversification, and every incremental ETF actually reduces the diversification aspect. So I wouldn't overthink it, but I just wanted to give you some key insights in terms of things to look at. I mentioned before, cost is very important, particularly for your time horizon. So if you're investing for 10, 15, 20 years, cost is obviously going to be a bigger factor. But let's say you are actually trading a short-term theme or something that is a little bit more medium-term in general, or maybe the cost isn't that important and you want to look at something else. So it's really a function of your time horizon, which is where the different types of factors will place greater importance. Again, performance, everyone loves to see good returns. I always joke and I say I've never seen a bad back test. I mean, I get pitched products all the time and they say, Mark, look at this amazing back test. So again, last year's losers can easily be this year's winners and vice versa. But it is important that the historical record of that particular strategy can actually hold up during both up and down markets. Now, why is size important? That's our third bucket. Well, size is really a function of liquidity, which we'll talk about in a bit, but also how commercially viable it is for us, Global X as an issuer, to run a particular strategy. And what you see is sometimes ETFs go to the graveyard. They actually close down and shut down because they didn't amass enough funds to make it commercially viable. And a lot of people say, well, what's that sweet spot? We like to think anywhere from around about, depending on the fee, around about $20 to $25 million, sometimes a little bit more, can really be that, I guess, that first stage gate that a lot of ETF issuers want to get to. So definitely pay attention to the size of the ETF, just in case the ETF does shut down, which can cause potential consequences down the road when it does. Liquidity and spreads go hand in hand. So when I talk about liquidity, I'm talking about how much is the actual ETF trading every single day. And the reason why you want a lot of liquidity is just in case you want to get in and out. Again, you don't have to be trading these ETFs every day, but just say, I want to sell something and go into something else. Having that liquidity is really important because let's say you're in a closed-ended vehicle or something else that doesn't have that great liquidity pool, well, then you could have a bit of problem getting out, such as we saw during market drawdowns like COVID, like the GFC, like the Euro debt crisis. But ETFs have time and times again withstood that volatility and still provided a liquid market. Because even if you see on screen that there might not be liquidity, there's another pool of liquidity of the underlying companies or the underlying securities themselves. And then the spreads kind of takes into account the cost, but it's the cost of getting in and out. And generally with an ETF that's a big size, lots of liquidity, you'll generally see the spread. So this is the cost to either buy or sell the ETF, not the brokerage. There's normally a little spread if you look to buy one. So let's say an ETF is trading at $10. Sometimes the buy will be at $10.01 and the sell will be at $9.99. That's the spread that these market makers make in terms of their arbitrage opportunities to provide liquidity to the market. So definitely pay attention to that. And then the last two is around the track record, so the historical track record of that particular strategy, but also really pay attention to the exposure. And by that, I mean, when you buy an ETF, go to the ETF issuer's website, look at the top holdings, look at the methodology, because most of the time it will be transparent. Sometimes the active ETFs protect their intellectual proprietary systems by not disclosing everything. But have a look. If I'm buying a a battery technology ETF as an example, have a look and make sure that those top 10 names align with that theme of battery technology, electric vehicles, lithium, because sometimes just because the name of an ETF says it does one thing, the actual exposure could be quite different. So definitely pay attention to the exposure of your ETF and the underlying track record too. Now, the last part of the presentation I want to get into is around smart rebalancing. So you can have, you can understand that the ETF market's growing, you can build the right things in your portfolio, but unless you rebalance, you actually are doing yourself a disservice by not actually sticking to that risk profile that we spoke about earlier. And what I mean by rebalancing is about tinkering with the weights in your portfolio to those asset classes, not too much, but just making sure, to use that porridge analogy before, that the temperature is just right. Because sometimes it can get too cold or too hot, and we want to bring it back into that equilibrium standpoint. Now, this chart is going to look like a lot of different colors, and you're going to be like, Mark, what is going on? But all I wanted to show is that one of the best things you can do when it comes to investing is to diversify. And on your screen is looking at the annual returns over the last 10 years of all the different asset classes. So we've got gold, international shares, Aussie shares, etc. And there's a lot of different colors and a lot of moving parts, which shows how hard it is to really time the market. International shares, gold, they've done really well, but there can be times like in 2018, 2019, even 2021, where they don't do as well. And that's where you want to have a diversified set of assets, because you don't know what the next winner is going to be. And, a lot of people are saying, well, is the international market going to continue? Will Australian shares come back? Are Aussie small caps, emerging markets going to outperform? No one knows. No one knows. Not myself. If I knew, I would not be doing this webinar. I'd be sitting on an island somewhere, sipping my pina coladas and letting my portfolio do its work. But actually taking a bit of an intellectual humility approach and diversifying across these different asset classes is the best way, I believe, for investors to actually allocate. Because what might be a great performer one year could easily be a bad performer the next year. The other thing I would say, and I mentioned this before, SMSFs trustees are great when it comes to their psychology of investing, because a lot of them have not just been through market cycles before, but tend to have longer holding periods. But don't be swayed by the news rhetoric. And right now we're dealing with a lot. We've got Trump going absolutely ballistic when it comes to trade wars, when it comes to geopolitical tensions, uncertainty around inflation, what's going to happen with the recession. A lot of news headlines will dictate the market because that's what drives clicks. And if you listen to what I call these Armageddonists, so these are some of the smartest strategists in the world, every time they recommended to go out of shares and into cash and bonds, well, a lot of the time you would have been down multiple amounts, down as much as 60, 70%, as the chart shows in the screen. And I think now more than ever is a great time to actually tune out the noise, zoom out, and just stay very, very diversified, and use this as good entry points to potentially dollar cost average into the market. Because the chart on the right-hand side of your screen shows that even though the average, the benchmark or the average index does pretty well, the average investor actually doesn't do too well. And this is what's called this behavior gap, that investors are often using news or using headlines to drive portfolio decision making, which in my view is not the right strategy. So this is a great time where it really is important to make sure that you have a really well diversified portfolio, but also not acting on what's going on in the news at the moment, because there's a lot of people who have either said to sell their shares, go into cash. But if you did that, like as an example, during COVID, the market's pretty much doubled since then. So over time, the market, usually the share market outperforms bonds or cash-like instruments, not every time, but investing is really the price of admission that you pay for handling this market volatility. So it's really important for investors to keep their emotions intact. And why that rebalancing is important is if you can just have some rules-based methodology to how you rebalance your portfolio, you can actually remove all the emotional biases and have a smart algorithm or a smart way of adjusting your portfolio mix. So what the left-hand side of your screen shows is growth assets. We were talking about things like shares, property, some alternatives. Those represent the orange bar. And then on the top is the defensive assets. So these are your cash, bonds, gold, etc. Let's say you were in a basic 60-40 portfolio, 60% shares and 40% defensive assets. If you didn't rebalance, and when I mean rebalance, I'm talking about selling some of those shares because they've become overweight and allocating them back into the defensive assets, you can see that over those 10 years, your share allocation has now gone from 60% to 80%. And that might not align with the risk tolerance bucket that we were talking about earlier. And this is where it's important to employ some rules-based smart rebalancing systems, which I'll talk to on the next slide. And why that's important is if you look at the chart on the right-hand side of your screen, this shows the range of yearly returns that you can expect. And this is going back multiple decades through things like equities, bonds, and cash. And when it looks at things like equities, you can see, or the share markets, you can see you can have drawdowns as much as 40% in terms of annual returns, but you can have really high ones as much as 47%. And if you actually build a bit of a balanced portfolio, and that's looking at the right-hand side of your of the screen, that light blue bar, you actually reduce the range of outcomes, which can help investors sleep easy at night. So this is why having diversification and also having a rebalancing policy makes a lot of sense to help you achieve those long-term goals, but also help you rest easy. Otherwise, if you're taking on a lot more risk, your portfolio could be susceptible to larger drawdowns without you even knowing about it. So I think for SMSFs, there's a lot of technology nowadays where you can rebalance. ETFs naturally rebalance themselves. Those are, I guess, two internal ways to do it. The ways that I believe, and I've seen a lot of research show that people will ask, well, Mark, should I rebalance and change my portfolio every 6 months? Should I do it every year? Should I employ some sort of threshold base, which I'll talk to now? The overarching message I want to leave you is that it does not matter as long as you have a rebalancing policy in place. I've seen so much research that show that it really, whether you're rebalancing based on time or threshold, the end returns are not that meaningful from a statistical significance perspective. So where I've seen two great rebalancing methods work, one is threshold based. And when you're thinking about rebalancing, if you look at the pie charts, you can see that, let's say you had 40% in Australian shares absolutely ripped, and now they become 54% of your portfolio. That's where you can bring it back to 40%, that strategic asset allocation weight, and then allocate the proceeds to the smaller parts of the portfolio that have become smaller in size, such as bonds and such as gold. And what you can do with a threshold-based rebalancing system is you can say that any time that the weighting increases more than 5 or more than 10% from its long-term target, that's a trigger to reallocate it back into its original target base. So that's when you're looking at the threshold-based, how much percentage it can be. Now, a lot of the time, it could be a bit complicated for investors to look at it. Again, there is smart technology or automatic advice systems that can help you with that. But sometimes it just is important to have a time-based rebalancing strategy in place. So if you're working with an advisor, as an example, and you see them every 6 months, that could be a great time to review the portfolio and have a look at, well, where can I be allocating and how far drift have I had from my original asset allocation? And just because, even though some SMSFs are normally in the lower tax bracket, some are still in their accumulation phase. So for those who are sensitive to capital gains tax, this is where instead of actually selling, you can just make sure that any time you're adding new super contributions to your SMSF portfolio, that's getting allocated, not necessarily to the original weight, but to the most under-allocated weight. So let's say in this example that gold was underweight because it hasn't performed as well. Well, that's where your new contribution should go solely into gold rather than that original investment mix. So really important to have a system in place to make sure that you can stay aligned with that long-term strategy. So I know I went through that really quickly, but I did want to open up to the floor if anyone has any particular questions. Again, I'm super bullish on the ETF industry overall. Soon we'll be at $300 billion, and soon we'll be at $1 trillion over the next decade. And I think that for SMSFs who are looking to have building blocks in their portfolios, look to diversify away from single stocks and look to diversify away from expensive active funds, I think ETFs provide a perfect avenue for that. They're low cost, they're cheap, they're transparent, they're liquid. These are all things that I think a lot of SMSFs, even though they are only allocating a small part of their portfolio to ETFs, it is growing, and I don't see any sign of that slowing down anytime soon. And once my super balance is big enough to make it from a cost-effective perspective, I'll definitely be opening up my own and building an ETF only portfolio from an SMSF perspective. So that I'll stop there and I'll bring back Darren to talk about some of the Q&A that we can go through.
Okay, Mark, and I'm pleased to tell you that we do have some questions, which is really good. So I'll just do these in order that they've come in so far. Um, the first one is, what are some minimum yardsticks one should consider? For example, minimum funds under management, minimum liquidity, buy, sell spreads. I think they're talking about the way that you assess that chart that you showed, the relevant things to assess an ETF on.
Yeah, great question. I think that was from Victoria, so thank you for the question. And when it comes to yardsticks, I think there's general principles or general, I guess, stages that people can look at, but there's no hard or fast rules. I mentioned with the funds under management, a lot of people would look at if a fund has at least 20 to $25 million in assets under management, just to make sure it is commercially viable. That being said, there are some funds that have recently launched that haven't met that scale just yet. An example of ours is our defense technology ETF. It's relatively new. I think it's just crossed 10 million in assets. And that doesn't mean that it's going to close down anytime soon, but it just could take a little bit of time. So when you're looking at the fund, have a look at how much size is in there, and then look at how long that ETF has been alive for. If it's a ETF that has less than 10 million in assets and it's been there for about 3 to 5 years, generally the 2 to 3 year mark is where a lot of ETF issuers will say maybe we should reassess. So that would be on the fund side. Liquidity really depends on the underlying ETF itself. So if you look at like an example of gold, gold is one of the most liquid investments out there. Gold actually trades a lot more, funnily enough, than some share markets do. Our gold ETF trades about $10 million a day, whereas other gold ETFs trade about $1 to $2 million a day. Now, share ETFs might trade a little bit more than that. So when you're looking at how much turnover, and this is where you're either looking at your brokerage platform or asking the ETF issuer, tell me about the average turnover. That will help you in terms of understanding, well, how much is this ETF actually trading every day? That being said, Victoria, if you do want to place a large order, and let's say you see that as an example, let's say our cybersecurity ETF, right? We've got one and it only trades a couple million a day. Let's say you're looking to deploy a few $1 million into that. And that's where you can use how much am I investing relative to the turnover. You can actually call our capital markets desk and they will actually go to the market maker and say, well, look, we've got a potential investor who's looking to invest $5 million into this particular product. Can you create a good price for them? And then it'll come up on screen. And that's how you can ensure that you're not going to, I guess, move the market too much or get an unfavorable price. And that also dictates the buy and sell spreads. When you're thinking Australian shares, think very low cost. Those spreads should be very much in the single digits. I'm talking 0.02, 0.03, 0.04%. When you're looking at more illiquid markets, so if you're looking at smaller companies, if you're looking at things like the Indian market, Asia, or some other types of, I guess, more esoteric geographic areas, those spreads can be a little bit higher. So it really depends on the type of exposure you're looking to get to. But again, I wouldn't overthink it too much. Just use these as guiding principles overall.
Victoria's got a couple of other questions, and we thank Victoria for her participation in today's presentation. She's asked whether or not you've got a table or data with suggested guidelines, I think in relation to obviously that first question that you just
Yeah,
answered.
yeah. I guess, like I said, Darren, it's a little bit hard to say like this is the rough guide for because it does depend on each one. But I'd use some of those like hard and fast rules, such as that minimum AUM of about 20 to 25 mil. The liquidity is a hard one because it does depend on the underlying exposure. But no, there's no hard and fast guidelines, I guess, that we have because it really depends on the asset class. But again, we can definitely take that on board and see if our team can actually come up with general investing principles around some of these guides and provide that to your viewers, which could make it a bit more useful.
Yeah, I think she actually acknowledges that in the third part of her interaction because she says, of course, these would be
Depending on
customized
the asset
depending on
class.
asset class and strategy, which is exactly what you just said. So
But no, we'll take
very,
that on board, Victoria. I appreciate the question.
very good. Now, both Jeff Bloor and Roy Curry have asked whether or not the presentation slides will be available after the seminar.
I assume so. I mean, I assume we'll be able to distribute it. That's probably a question for you, Darren, and the team. But yeah, I mean, we're happy to share anything, and we give a lot of these presentations. So I'll leave that
Well,
up to your team, but hopefully that will be available.
well, I think that's actually a pretty good cue for me to actually tell whoever's logged in on this webinar that a recording of this webinar will be available on our website after its completion. So you can go through the entire presentation again, obviously with the attached slides with it. It'll be exactly the same presentation that you've seen today. So that's obviously one way that you can get the slides, and it's probably the best way to access the slides because you'll get Marc's commentary with them, which obviously will help the interpretation of the data and the statistics that are illustrated on those slides. So that's kind of the answer to that one. We've got less, slightly more shy attendees because these are under the guise of anonymous. But one question is, how can ETF investors manage the concentration of indexes from a diversification perspective?
Also a really good question, and thank you for that. It's definitely the talking point right now in terms of you look at some of the big companies at how much they actually make up of the broader S&P 500. You're talking concentration not seen since the dot-com boom. And a lot of people are asking, well, does this actually mean that there's going to be destruction like there was during the dot-com boom? I guess even though the weighting of the portfolio is quite high, you've got to think about how much of the earnings that these companies are actually contributing to the overall market. So if you look at the dot-com boom, the top 10 companies made up, 30 or 40% of the index, but they didn't make up a lot of the actual earnings and cash flow. Whereas now the Magnificent Seven and all these companies really are making up a significant chunk of the actual earnings, which is driving the share market. That being said, for ETFs investors who are a little bit concerned around concentration, the great thing is, and this is where it's really important for when you're buying an ETF, look at the index methodology. It's available on every issuer's website. And if it's not, email them or call them and ask them for a copy of that index methodology, because that's what most ETFs follow, is just a rule, is to look at how the actual companies weighted in the ETF. Most ETFs by nature will do something called market capitalization, which just means the bigger the company, the bigger the weight in the portfolios. But if you're worried about concentration, which it sounds like this investor might be, look at things like equal weight strategies. So there are some Australian ETFs that have exposure to both the Australian market, the US market, and also thematics that actually decide, you know what, instead of weighting the ETF, the underlying constituents by size, we're going to assign every company the exact same weight. So if you're investing in, let's say, the ASX or the S&P 500 as an example, everyone is going to get a 0.2 percentage weight, just to make sure that it equals 100. Not just that, but you can also have a look at whether any ETFs actually apply a cap to the ETF. So an example is we've got our growth at a reasonable price ETF. The ticker for that is GARP, G-A-R-P. And what I like about it is it actually makes sure that any company won't have more than a 5% weight in the portfolio on its rebalance date. So for companies like Nvidia, which shot up to 5, 6, 7, 8, 9, 10%, it'll rebalance back to 5%, which is talking to that smart rebalancing aspect. So definitely have a look at the index methodology. There's a great range of ETFs out there to provide the diversification, and also not just diversification around the concentration, but also around different countries. So right now, if you invest in a global ETF, you're most likely going to get the US, given it's 70% of the index. But then you can actually invest in global ex-US countries or regions, or Europe, or India, or China. So there are a range of different ETFs that can actually manage that concentration risk for you.
Okay, another anonymous attendee. Thank you for the presentation, Marc. They've got a couple of questions. What are some new directions? I think you touched on this with thematics when you were talking about the core satellite approach. What are some of the new directions or asset classes ETFs will move into in the coming years?
Well, very, very good question. So I think that naturally ETFs are going to evolve over time. And what you saw is historically it was just about providing very boring, simple, vanilla exposure to the broad indexes. Then it became a lot more about, this is probably around the late 2000s, I would say, it became a lot more popular to go into certain sectors and in certain countries. Then we saw, I guess, more recently, the resurgence or the heightened increase in environmental, social, and governance, so sustainable ETFs. Funnily enough, they've actually are now at their lowest in terms of popularity. So they were very, very popular during COVID, and now not so much. You've also seen the evolution of what's called smart beta. So this is strategies that don't weight their constituents, like I was saying before, by size, but are using things like equal weight, or using things like cash flow or yield or different types of, I guess, smarter strategies. And then you're also seeing new asset classes coming out. So cryptocurrency is one where I'm not sure who's dabbled with, but you're seeing a lot more ETFs happening, coming to market in that respect. You're trying to see as well, a lot of people and a lot of investors yourself might have been getting a lot of advertisements from illiquid assets like private credit or private equity or private or venture capital. The ETF wrapper are trying to work out how we can actually wrap up illiquid securities in a liquid investment. Personally, I'm a little bit of a skeptic when it comes to that, just in terms of having that deep liquidity for something that doesn't trade every single day. But you are going to see just a lot more exposure to certain markets, certain strategies, certain types of asset classes that were once hard to get access to. And I think that's the great thing about ETFs is, before, as an example, gold, you had to buy gold miners up until 2003, and now you can actually invest in the physical gold itself, assuming you don't want to actually go and buy it from the physical bullion market. So yeah, ETFs are going to continue to innovate. We'll see more active ETFs come to market as well, because a lot of these active managers are seeing this as a very lucrative market and an easier wrapper to actually package their strategies. And I see that while we're at about 400 ETFs at the moment, if you look at the US, they well into the thousands. So there will be a lot of complex ETFs that come to market, such as using derivatives and option strategies, which could provide some use for clients. But I also think that usually it's a simple ETFs that work the best.
They've obviously listened to the part where you were talking about active managers and obviously the effective use of ETFs versus active managers. And they're looking, the next question is, I suppose, probably a rule of thumb. How can investors detect an asset manager is actually hugging the index, which is effectively what an ETF is doing, only you're paying higher fees, of course.
I couldn't agree with you more, Darren, and thanks for the question, because this is probably my biggest pet peeve. Is you've got essentially these benchmark huggers, or these closet indexes, as I call them, for active managers who are literally just buying the index. And now, when it comes to things like superannuation funds, they've got their performance test benchmarks that they need to meet. Otherwise, they'll be handed a notice from APRA to say you're failing to meet this actual benchmark. So they are even incentivized more to actually hug the index way more. So for investors to actually look, well, how much is to actually see, is this manager actually an index hugger? The question I would ask them is, go to your active manager and ask, what is your active share? Right? Those are two words which may sound complex, but all that looks at is how similar are their holdings to an actual underlying index. And what you actually want to see is you want to have their active share to be really, really high, which means that they're not holding the same securities and the same weights as the underlying index. So if you have a fund manager that has an active share of 80 to 90%, that's a good thing. It means that 80, 90% of the portfolio is not in the common shares that are held in the index. Whereas if the active share is really low and you look at their top 10, top 20 holdings, you look at the correlations and you look at they're the same as the index, yet they're charging 1%, I would be very, very, very skeptical. And we've done some great research that shows that some of the largest fund managers for a basic Australian share ETF, if you look at their top 10 holdings, big banks, big miners, CSL, etc., their underperformance translates exactly to the fees that they're charging. So I think investors are becoming a lot more conscious of fees. And rather than this idea of active versus passive, I actually see it as a high cost to low cost. Most of the flows in ETFs are going into low cost ETFs, those charging less than 0.30%, whereas those that are having charging more than 1% are actually seeing outflows. And I think that is the key for investors. Keep your costs low. And if you are concerned about your active ETF being an index hugger, ask them, what is the active share? And ask them, please show me the holdings. Show me the top 10, the top 20, and the weightings, and to look at the similarity between them.
That's a great answer, Mark, because I think you've answered one of the other questions from Kevin Zhang. He says, hi, Mark, what's your view on active ETFs versus passive ETFs index? And I think you've pretty much covered that in that last answer.
Yeah, I think with that, Darren, I mean, I'm a big believer in ETFs being a better vehicle from a tax efficiency perspective, a liquidity perspective, transparency, all the above. They tick a lot of marks, but it's almost, and I went fishing with my old man the other day, and just using a fishing analogy, just because you catch an ugly fish and it's packaged and it looks a little bit different, doesn't change the fact that it is still an ugly fish. So even though a lot of these active managers may be packaging their product as an ETF, that doesn't mean that it's a stamp of approval for all of a sudden for it to be a safe, low-cost investment vehicle. Because like I said, there are still active ETFs out there that are seeing outflows from their funds because not only they're underperforming, but they're charging a lot of money. So interestingly, in the US, it's very different. About a third of money going into ETFs is actually going into active ETFs, where in Australia, it's pretty much flat. And I think that in Australia, people like the idea of having a lot more low-cost options. And that's a problem. You're getting active managers coming out with high-fee products. There are some active managers out there, and call outs to some like Macquarie or Dimensional, that are coming out with low-cost ETFs. And I think those could actually, a lot more appropriate because they control for fees. But when you have an active fund manager coming out with more than 1% for something you can get exposure to less than 0.1%, I'm a little bit skeptical on the active management in terms of getting the most amount of flows. They account for a lot of the products and account for a lot of the revenue, but they don't account for a lot of the flows. So that's how I would distinguish between the active and passive side.
Yeah, Kevin's got a follow-up question. Do you think geared ETFs will be a viable product for SMSFs?
Also, we mentioned about product innovation, and you're starting to see, geared ETFs be quite popular. They've existed for quite a while. So we've had ETFs at certain, and when I'm talking about gearing, I'm talking about ETFs that either borrow or provide some magnified exposure. So as an example, I mean, we've got I wouldn't advise it for SMSFs unless you're a short-term trader, but we've got ETFs that track 2.75 times the price of the NASDAQ 100. So when the price goes up by 1%, you could expect this to go down by 2.75%. So that's the leverage side, but you're also seeing some ETFs coming out that are more lightly leveraged or apply a moderate level of gearing. So if you think about for $1 exposure, maybe I'll get $1.4 of exposure. And I think that actually can be quite useful, particularly for investors who are buy and hold investors who are holding for the long term. I would not be using these ETFs for anything less than 3 to 5 years, in my opinion. This is a more a 5, 10, 20-year plus holding. And also for a lot of SMSFs who have certain contribution caps that they might be hitting, this is a great exposure to actually get a little bit more of an exposure. If you wanted to invest, $15,000, $20,000, but you actually meet that contribution cap, you can actually get a bit more of a magnified exposure by looking at these geared ETFs. So when you're looking at geared ETFs, ask what the gearing ratio is. How much magnified exposure? Are you getting 2 times, 2.5 times, or is it a bit more lightly leveraged? Because I think the more lightly leveraged ones could be more appropriate.
Okay, here's another one from an anonymous attendee. Is there an ETF that pays a dividend rather than a distribution in an SMSF that can be wound up quickly? Context.
Yeah. So a bit of context around how, I guess, ETFs work. So ETFs don't necessarily pay a dividend to investors. It pays a distribution, but as part of that distribution, it includes multiple avenues of that type of return. So within a distribution, you can get dividends, you can get things like franking credits, but you can also get things like capital gains, interest, foreign income tax offsets, foreign income. There's a range of different components that make up that overall distribution. So when there is a distribution announcement from the ETF issuer, it will actually have the breakdown in terms of percentages of how much is actually from the dividend itself, how much is from the capital gains. Because if you think about it, if an ETF is rebalancing, and let's say it's rebalancing the ASX 200, CBA has done really, really well, but now we have to sell it back as part of its quarterly rebalance to get it back to its normal weight. Well, if there's a capital gain that's part of that, that'll get distributed to investors. So it's very rare for an ETF to only pay a distribution that's made solely of dividends. That being said, you can get dividend-focused ETFs. So we've got one called ZYAU, but there's a bunch of like 4 or 5 different dividend-orientated ETFs, which only focuses on companies that are paying really high dividends. And you can get them usually on a quarterly basis, sometimes semi-annually. But just pay attention to the components, and you'll get that in your end of year tax statement, which shows how much is part of an actual dividend, how much is franked, how much is unfranked. There's a range of different components, but as far as I'm aware, it's very rare for an ETF to pay 100% dividends without some other components, such as a little bit of interest, such as a little bit of capital gains, just because of that rebalancing process too.
Speaking of rebalancing, the next question is about that. You said ETFs are self-balancing. What ETFs have gold, share, property, cash in them?
Also a very good question, and this is something that's recently I think Vanguard actually launched two ETFs last week. First time they've launched an ETF since 2020. But you are seeing increased appetite for what's called diversified ETFs. Now, these are ETFs that hold underlying ETFs or underlying funds themselves. And this can really be a smart solution for investors who don't want to go through the nitty-gritty picking of all the underlying asset classes, and all you want to do is invest in a growth ETF or a balanced ETF or a conservative ETF. The only issue with that, and I don't know who asked the question, but it's a great question, is a lot of these ETFs do not hold gold. And if you look at some of the biggest super funds or the biggest diversified funds in Australia, a lot prefer illiquid private assets such as infrastructure, such as private credit, over a true defensive asset that provides not only an inflation hedge, but also a hedge against uncertainty. And we're seeing gold now at record prices. There isn't an ETF at the moment that has an allocation to gold in terms of a diversified sense. You'll get a lot of diversified ETFs that have access to shares, access to property, fixed income cash. But gold is one of those ones that still hasn't made it into a lot of these diversified ETFs. So there's about, from memory, about 10 to 12 different diversified ETFs out there. Some are focused on your broad vanilla stuff, some go into income, some go into different growth tilts. There are even some ESG or environmental diversified ETFs. Just do your due diligence, but for ones that have gold, maybe that's something where as a satellite, you'll add gold to the portfolio as well.
And I think we'll wrap it up with this question. Mark, in your opinion, many ETFs should make up the, you're just talking about the core satellite portfolio and marrying that with the idea that maybe 5 to 7 ETFs is how many you want to include in that. The question is, what's the ideal total in the core part versus the satellite part?
Yeah, like I said, I only think you need probably about 4 to 5 key asset classes in your portfolio. So Australian shares, global shares, you might want to split that global shares into both developed and emerging, then adding maybe 1 or 2 fixed income exposures, and then finally the gold ETF as a bit of a defensive hedge. So really, I believe that you probably only need 5 or 6 ETFs to have that core part of your portfolio. That being said, and to the previous question, there was that all-in-one solution where you could just buy one ETF and get access to all of them. And I mentioned this in the presentation before, but the more asset classes you add, the more complex your portfolio gets, the harder it is to manage, the more costs you may be paying, and not just that, the overlap of securities that you may have. So whenever a new ETF comes out, the question I would ask is, how could that fit into my overall portfolio and what exposure does that solve? There's no point owning 2 ASX 200 ETFs because there's a new one that came out, or 2 global share ETFs because the exposures are the exact same. You're just doubling up on fees, doubling up on exposure, and if anything, you're getting instead of diversification, it's called diversification. So I would be very conscious of that. That being said, there are ETFs out there that can solve a particular problem. We mentioned around concentration risk and how you can actually overlap that to create a bit more balance. And then this is where the core part of your portfolio with those 5 to 7 ETFs, keep that static, keep that the same, dollar cost average and rebalance. And then if you do want to have fun, like I mentioned before, play in the other areas around the fringes. And if playing around in the fringes stops you from touching the 80 to 90% of your portfolio, which is that core part, well, that's a natural behavioral hack in itself. Because if you're having fun with all the satellites, the core part of your portfolio is just going to keep doing its thing. So there's no hard and fast rules with investing. I'm just a big proponent and a big believer is less is more, which is probably not something you want to hear from, a lot of, Darren, you gave me a great intro saying I've had over a decade in markets, but I've been to so many presentations where I'm seeing leading economists, people smarter than me, way smarter than me, and I don't even understand the things they're saying when they've got things on screen, because a lot of the stuff is just jargon. And jargon is what helps, I guess, investors, probably like the ones on the call, feel a little bit safe because it makes them feel, oh, this person might know what they're talking about. But I just think it's just job security for them. And a lot of the time, when it comes to investing, simplifying or doing things simpler sometimes gets better results, which is the exact opposite of most avenues in life. If you want to lose weight, well, you have to train more. Or you have to buy a personal trainer. If you want to get a better car, well, you have to pay more money for that sort of thing. Investing is one of the few things in life where the less you do and the less fees you pay, the better you can actually do. So yeah, that's I guess a well-learned answer for for my answer of keeping that core part of your portfolio quite simple with only a handful of ETFs.
Well, I think that's a great note to conclude on. So I'd just like to thank you, Marc, for giving us your time to host this webinar. It was certainly very informative, and I think you covered some great topics. I think that was evident from some of the questions that we got about ETFs and wanting to know a little bit more about these investment vehicles. So thank you very much for your time today, Marc.
My pleasure. Hope everyone enjoyed some time on the call. And if you need any information, I mean, you've got the wonderful team here, but feel free to come to our website or reach out to me if you want. I'm always on LinkedIn if anyone has any further questions as well.
Just a quick reminder from me, again, if you'd like to revisit this presentation, a recording will be available on our website, the SMS Trustee website, shortly after this this live webinar concludes. So you can see all of it, Marc's commentary, as well as the slides that he presented too, which I think would be great to revisit. I think I'll be doing that myself. Other than that, I'd like to thank my own team for producing this and making it happen. Can't do it without them. But most importantly, thank you to all of you who joined us today on the webinar. Obviously, we can't do these things without you, and we hope you found it useful, and we hope you enjoyed the content as much as we enjoyed bringing it to you. Other than that, have a great day. Thanks again, Marc, and we look forward to seeing you next time we host an investment webinar for SMSF trustees. Thank you, and bye for now.